Two neighbors on the same street. Both drive 4-year-old sedans. Neither has had an accident or a ticket in 5 years. One pays $1,200 a year for car insurance. The other pays $3,800. Same street, same driving records. The difference isn't luck. It's a system that prices risk using factors most drivers have never been told about. Car insurance rates in the United States have risen more than 50% since 2020. In 2026, the average American pays over $2,300 a year, and in some states, more than double that. This isn't a gradual trend. It's a spike, and most people have no idea what's driving it. This is why your car insurance costs what it does, and why it keeps going up. Car insurance is a bundle of 6 separate coverages, and most people couldn't name them. Understanding what you're paying for is the first step to understanding what you're paying. Liability is the core. It's legally required in almost every state. Bodily injury liability pays for other people's medical bills if you cause an accident. Property damage liability pays for the other car, the guardrail, the fence. These have limits. $50,000 per person and $100,000 per accident is a common policy. Collision coverage pays to fix your own car after an accident, regardless of fault. Comprehensive coverage handles everything that isn't a collision: theft, hail, a tree falling on your car, hitting a deer. Uninsured and underinsured motorist coverage protects you when the other driver doesn't have insurance or doesn't have enough. About 1 in 8 drivers on the road has no insurance at all. Medical payments or personal injury protection covers medical bills for you and your passengers after an accident, regardless of who caused it. In no-fault states, PIP is mandatory. Most states only require liability, the minimum you need to legally drive, but minimums are often dangerously low. A state that requires $25,000 in bodily injury coverage is requiring you to carry less than the cost of a single ambulance ride and an overnight hospital stay. Between 2020 and 2026, car insurance premiums have increased faster than almost any other consumer expense. Several forces hit at once, and the industry is still catching up. The biggest factor is repair costs. Modern vehicles are not these simple machines they were 20 years ago. A front bumper on a 2024 sedan isn't just plastic. It houses radar sensors, cameras, and parking assist modules. Replacing a bumper that cost $400 in 2010 now costs $1,200 to $2,000 because of the technology embedded in it. Recalibrating the sensors alone can add $500 to a repair bill. Parts inflation compounded the problem. Supply chain disruptions from 2020 through 2023 drove up the cost of auto parts by more than 30%. Labor costs at body shops rose as well. There's a nationwide shortage of qualified auto body technicians. Vehicle theft surged, particularly catalytic converter theft. The precious metals inside a converter can be stripped in under 2 minutes and sold for $200 or more. A wave of Kia and Hyundai thefts, enabled by a manufacturing vulnerability that went viral on social media, added billions in claims. Weather events are getting more expensive. Hailstorms, hurricanes, wildfires, and flooding caused record-insured losses in recent years. These aren't just coastal problems. A single hailstorm in Texas can generate hundreds of millions in auto claims. Distracted driving has pushed accident frequency higher. Despite safer vehicle technology, fatal crashes have increased since 2020, in part because of smartphone use behind the wheel. And then there's litigation. Jury verdicts in auto injury cases have grown significantly, with so-called nuclear verdicts, awards exceeding $10 million, becoming more common in some states. Insurers price this risk into every policy. None of these factors are temporary. They represent structural changes in what it costs to insure a car. Insurance companies use actuarial models that weigh dozens of variables, but the factors that move your rate the most are simpler than you'd think. Your driving record is the single biggest factor. An at-fault accident can increase your premium by 40 to 60%. A DUI can double or triple it. Even a speeding ticket adds 10 to 15% in most states. Your credit-based insurance score is the second most powerful factor and the most controversial. In most states, insurers use a version of your credit history to predict how likely you are to file a claim. Studies show a statistical correlation, but critics argue it penalizes low-income drivers who may be perfectly safe behind the wheel. California, Hawaii, Massachusetts, and Michigan have banned this practice. Everywhere else, your credit affects what you pay. Age and experience matter significantly. Drivers under 25 pay the highest rates because they statistically have more accidents. Rates drop steadily through your 30s and 40s, then start rising again after 65. Where you live, down to the zip code, affects your rate because it predicts claim frequency. Urban zip codes have more accidents, more theft, and higher repair costs than rural ones. Your specific neighborhood matters more than your state. Your vehicle determines repair costs, theft risk, and safety ratings. A sports car costs more to insure than a minivan, even if you drive them the same way. Cars with high theft rates cost more. Cars with better crash test ratings cost less. Your coverage choices are the factor you control most directly. A $500 deductible costs significantly more than a $1,000 deductible. Raising your deductible is the single most effective way to lower your premium, but it means paying more out of pocket when something happens. Car insurance rates vary more by location than almost any other consumer product. Where you live can matter more than how you drive. The most expensive states, Florida, Michigan, Louisiana, and New York, share common traits: high litigation rates, expensive medical systems, and in some cases, unique regulatory structures. Michigan, until recently, had unlimited lifetime medical benefits for auto accidents, which drove premiums to extraordinary levels. Florida has a high rate of uninsured drivers and significant fraud. The cheapest states, Maine, Idaho, Vermont, Ohio, tend to have lower population density, less litigation, and fewer weather catastrophes. No-fault states require your own insurer to pay your medical bills, regardless of who caused the accident. This reduces lawsuits, but increases claim costs. Tort states allow the at-fault driver's insurer to be sued directly. Each system creates different pricing dynamics. State minimum coverage requirements vary wildly. Florida requires only $10,000 in property damage, liability, and no bodily injury liability at all. Maine requires $50,000 per person and $100,000 per accident. The state you live in determines the floor of what you're required to carry, and those floors are set by legislatures, not actuaries. Here is something the insurance industry would prefer you didn't know. In most cases, staying with the same insurer costs you more than switching. Insurers use a practice called price optimization, adjusting rates based not just on your risk profile, but on how likely you are to shop around. Long-term customers who auto-renew without comparing prices often pay higher rates than new customers with identical risk profiles. Some studies have found that the loyalty penalty can amount to hundreds of dollars per year. Several states have pushed back against this practice. California, Maryland, and Ohio have restricted or banned price optimization. But in most states, it's legal and widespread. The industry justification is that acquiring new customers is expensive, so introductory pricing reflects marketing costs. The practical result is that the most loyal customers often subsidize the discounts given to new ones. There are specific points in the system where drivers consistently lose money, often without realizing it. Trap 1. State minimum coverage is not enough. If you carry the minimum $25,000 in bodily injury coverage and cause an accident that results in $200,000 in medical bills, you are personally liable for the difference. Your wages can be garnished. Your assets can be seized. Minimum coverage protects your right to drive. It does not protect your finances. Trap 2. Comprehensive and collision drop-off. If your car is worth less than the annual cost of your collision premium multiplied by 10, the coverage may not make financial sense. But most people never do this math. They keep paying full coverage on a car that's worth $3,000. Trap 3. Duplicate medical coverage. If you have good health insurance, the medical payments coverage on your auto policy may be redundant. In some states, you can reduce or decline it. Trap 4. The bundling assumption. Bundling home and auto with the same insurer gets you a discount, usually 5 to 15%. But if the base rate from that insurer is higher than a competitor's unbundled rate, you're paying more for the privilege of a discount. So why does one neighbor pay $1,200 and the other pay $3,800? Neighbor A is 42 years old with a clean driving record and an excellent credit score. She drives a Honda CR-V, one of the cheapest vehicles to insure. She carries a $1,000 deductible and has been quoted by 3 insurers in the past year. She chose the lowest offer. Neighbor B is 23 with one at-fault accident 2 years ago and a fair credit score. He drives a Dodge Charger, a high-theft, high-horsepower vehicle. He carries a $500 deductible and has been with the same insurer since he got his license. He has never compared quotes. Same street, same state law, same road conditions, completely different risk profiles, and completely different consumer behavior. The system priced them both accurately according to its own logic. Whether that logic is fair is a different question. Car insurance isn't expensive because of one thing. It's expensive because repair costs, technology, weather, litigation, and pricing models are all moving in the same direction, up. The system that sets your rate is complex, but it isn't random. That's what this channel does. We read the fine print on the systems that cost you money, so you understand exactly what you're paying for. If this helped, subscribe. There's a lot more to explain.